Yeah, good day, everybody. Yeah, today we are going to talk about risk management and advanced for our risk management. In risk management, we have to deal with risk and the way we manage our money management. So, what are those tools that we need to manage our money? So, we have a lot sizing, stop loss and take profit planning, risk per trade calculation, managing trade psychology. All these tools help us to manage our risk very well. Let's go by the material. So understanding how to manage your risk is as important as knowing when and where to place your trade. When you know when to place your trade and where to get out of your trade, that's a good risk and money management. So many traders fail not because of a lack of knowledge or strategy, but because they ignore risk management and psychological discipline. So how do trader fails? Because they ignore a lot of things. It's not because they lack knowledge, but they ignore a lot of things. They ignore their risk management and psychological discipline. But when you have a discipline, you should have known that at also point, as also position, as also place, you are going to enter the trades. So let's break it down. Lot sizing. Lot sizing revert to the volume or size of your trade in forex. The standard unit of a lot sizing, as we have said in the past classes, standard lot size starts from 1, which is 100,000 units of base currency. So it started from 1 to infinity. If you have not gotten to that level, then we have a mini lot size, which is 10,000 units, which start from 0.1 to 0.9 lot size. So then we talk about micro lots. Micro lots which start from 0.01 to 0.09. Then we talk about nano, which is very infinitesimal. We don't use it's not common to be trading without this kind of a lot size. Why is this important? Choosing the appropriate lot size determine the level of risk on a trade. A large lot size on a small account can wipe out your capital quickly. When you use a large lot size on a small account, it's very easy for account to be wiped out, because when the market go against you, definitely your account size may not be able to cope or to carry the loss. Definitely wipe off the account. So the key is to balance for size with your account size and risk appetite. For example, you have when you have small account like $100, $50 to $100, it is very advisable to go for micro lot size, because we not like the way the account will be blown out if you use a lot size like mini lot size, not even to talk about standard lot size for $100 account, unless you are taking a big risk which can result to lose of that particular account. So trader are advised to begin with micro, as I said earlier, or mini lots until consistency and confidence confidence grow. So you can only use micro, I mean, yes, you should be using a small account owner should be using, it is advisable, it is being advised to be using micro or mini lot size until you gain your confidence and you are consistent with your winning. So that is that. Then we talk about another tools, which is stop loss and take profit. So stop loss and take profit is another tools that we can use to to manage our money and manage our risk. There are two essential tools for every disciplined trader, which is stop loss and take profit. SL and TP is a predetermined price level at which your trade will close if it moves against you, limiting your losses. For example, a stop loss is just like a point you have predetermined it, that when if this particular market or this particular asset price go against me, definitely the market should close, I mean my trade should close at this level. I cannot lose more than this. I cannot bear more than this loss. So you must have set that particular that particular price, that at this so point this market should close if it go against me. So that is stop loss. Then take profit too is a set level at which the trade automatically close when the price reaches your desired profit. You must have predetermined it too, that at this level it is likely for market to turn back. So before the market will turn back, please market, take my platform, take my profit for me, let me move on. I don't want to lose anything. So that is stop. So why use stop loss and TP? This is just important. So they help eliminate emotional decision making. So when it is being set, it won't allow you to just be taking any decision anyhow with emotion. You just put it there and leave it there. Let the market do its works. So they keep your risk control and profit secure. You don't have to monitor trade 24/7. So when it is being put, you don't need to monitor your trade. Just since you must have calculated the amount of money you want to lose, and you must have calculated the amount of money you want to make, then leave it there. Let the market do its work. Then from there, when you come back to the market, then you see your profit or the loss. So the stop loss and TP placement tips: always place your stop loss below or above strong support or resistance zone. When we get to that level, we will explain it. It's a tips you must follow. Your stop loss must be under or below a support or above a resistance. That's the stop loss. Then TP should be realistic and based on strategy, e.g. 1:2 ratio or 1:3 reward risk reward ratio. So that is that. Then avoid moving stop loss or TP unless strategy call for a trailing stop. There are sometimes you used to trade your stop, you used to trail it. So if your strategy call for trailing your stop loss, then you can now shift it. You shift your stop loss, but it is not advisable to be shifting it, because where you shift it to, the market might turn back and reach that place, and it might not reach your initial stop loss that you first set. So that is why it's not advisable to be shifting, to be moving your stop loss and your TP. That is that about the tools. Then risk per trade calculation: managing how much you risk on each trade is the foundation of long-term profitability. For example, as I said earlier, it is always good for you to know how much are you risking on a particular trade. You must have calculated it. So the golden rules of professional trading is never risk more than 1 to 2% of your trading account, of your trading capital on a single trade. For example, you have $100 account and you want to trade $100 account. Wherever you want to enter, wherever you want to put your stop loss, your account, your stop loss must not be more than $1 or $2. That is 1 to 2% of your account. If you are using 50%, it must not be more than $0.5 to $1. So it must be between 1 to 2%. So take that very much. This is an example. Account balance of 1,000. Risk per trade 2%, that's $20. Stop loss, that's 20 pips. So pips value, that's $1 per pips. So that is the standard lot. Micro lot. So for you to know how you are going to, what you are going to lose, you have to calculate. There is a general formula that I used to give to my students. That is 10 LP. When you use your 10 LP, that 10 is a constant number. The L, that's your lot size. Then P is the pips, number of pips that your price move, that your market, the asset move. Then if you slot in this particular formula into this create, it will give you the answer that you are looking for. So this prevent major drawdown and allow you to continue trading even after a series of loss. So this protect your capital. This particular thing we are talking about, this particular tools we are talking about, you're calculating the number of money, the money you want to lose, your risk management and money management. It protects your capital, just like a soldier that went to that is on the battleground, that finishes all the bullets without considering maybe an enemy can come out at any time. So you have to protect your capital for you to last long in the market. So managing psychology. Your mindset is your most powerful trading tools. Successful trader maintain discipline, patience and emotional control, especially under pressure. So what are the common psychologies that you need to understand? So I think we are going to talk about this in the next class. Thank you. This is from Qodelhar Forex Academy.